All right. Good morning, everybody. Green on the screen, a little bit like a dead cat bounce. We're not really bouncing all that much yet. Hong Kong flat, Dow up almost 0.5%. Russell flat, NASDAQ at a quarter. So we're holding the line, waiting on data. It's all about the jobs at this point. There wasn't much of a revision on the jobs numbers that we got last time, only 1,000. There's been some wild estimates about the forecast for today, with Boeing mixed into it and the hurricane mixed into it. We've heard some pretty far extremes when it comes to what the numbers could be. So if you've been around for a while and you've heard me talk about it, when I listen to the analysts and they're chipping their teeth and talking about things, and they're very arrogant and cocky because they think they got the numbers all figured out, that's when I get nervous, because they don't have it all figured out, and they've been proven throughout history to be wrong consistently. We're not in that situation. The numbers are so wild and variant that it really highlights that they have no idea what we're going to get today. And I'll take that. That's at least a more honest assessment than thinking they've got it all figured out. We also have ISM manufacturing this morning, be it 10 o'clock. Once we're done with that, we're really done with economic impact on the day, other than some news or anything that could come out, right? There's always that little asterisk that just warns us unknown news could hit at any time. That's not a surprise. We got lucky yesterday morning before the open that the drop in gold was something that caught my attention, so that I could warn that all of the discussion about going long yesterday was off the table, because that move in gold and dollar and yields took the confidence away that that was the play, gave the shout out, and it worked really well, right? Now, yesterday I did give levels to the downside, and I made it clear that all it would take is some news for something to get us down and break below that Globex low, and we would have a really great short. So if you missed that part of it, I went and cut it all out. It took about 3.5 minutes to watch the replay. I did give short targets yesterday, and I did warn all we had to do is break that low, right? The market can change direction no matter how bullish, no matter how bearish, 50% of the time between 9:30 and 10. Never forget that statistic. We are closer to the upper ADR than we are the lower ADR. We have a market maker move this morning, which shows that they are hedging. Now, they're always hedging. So that statement, when I say it on its own, it doesn't really hold a lot of weight, right? Because they're always hedging. This is unique, specific hedging to deal with a specific event at a specific time, right? It's a little bit different. There's also the fact of what they're hedging, or why they're hedging, why the ES futures are moving for this hedge. One, it's open. So, it's actually something that they can interact with. But two, all these brokers and dealers, when they've got a lot of SPX, they need to hedge that. And they use ES futures to do that. This isn't my opinion. If you've, worked on broker dealer, gone through any sort of education on that, then you'll see that that's just the way it goes, right? So it's not new. It's not a surprise. They are hedging today. This is like 0-day stuff. So spot gamma, trading ticks, anything that you can use to monitor the 0-day options flow, you're going to want to use that, right? Because that's what they're focused on. Now, the hedging at least fits in with the narrative that they have no idea what we're going to get today. But that makes sense. The volume's at 95, and that doesn't necessarily make sense. Typically, the volume is light while we're getting that hedging activity because they're sitting out, and they're waiting on the data. But we've got the volume showing participation, and we've got the hedging showing that they're concerned about the data point that's going to come out this morning. Now at 8:30, we have a chance for a liquidity gap play. This is a gap in liquidity, not a gap in candle, right? If you look at yesterday's close and we closed at 100, and today's open, we open at 120, that's a price gap. This is a liquidity gap. I don't know that we're going to get one of these candles, but at 8:30 on economic events, we have the opportunity for these candles, and one of those days is non-farm payrolls. There's also CPI, PPI, QRA. This is a pretty good list. These candles can show up in the intraday too. It's not something that only shows up for an economic event. And in the pictures I'm going to show you, it's on a 5-minute chart. I do most of my candle analysis for the intraday on a 5-minute chart. Some things to look for at 8:30 is that we get a candle that goes in one direction. It can go up or down. I don't care. But we don't want a lot of wick going in the wrong direction. And we want the candle to close near the end of its move. We don't want much of a retrace. Same thing here going in the other direction. There's not much wick here at all, just a tiny little nub of a wick. And we closed near the end of the candle. We came back to where the candle opened at 8:30. We came back to it at 10:30. In the other picture, we got there around 11 o'clock. That's pretty common. Here's another example, CPI day, almost no wick. Now on this one, we did pull back a little bit, but we stayed in that upper 25%. The next candle digested and consolidated within that zone, staying in that 25%. Then we broke out of that and continued the run, based across the top, and we still got the gap closed before 11 o'clock. This is what we do not want to see. This is non-farm payrolls from February 9th, 2 years ago, I think. Nope, at least the picture was from this year. So this is what we don't want. I got the measurement on there showing the halfback, and you can see how price pulled back. It left all that wick up there. But we also had another tail with that wick down here. That's not what we want. Now, don't get me wrong, the gap was closed, and it was closed really fast, but that's not what I'm interested in. Now, all of these candles, whether they leave a wick or not, whether it's a gap close or not, you can measure all of them. You can use their halfback levels. You can plot their breakout zones. You can still use them for other purposes, even if we don't trade the gap close with it. Here's another example, CPI from June. Big wicks on each side. I wouldn't want to use this for the gap close play. But if you measured this whole thing and projected it 50% higher, that was what we hit our head on that day. That's just straight out of the candle analysis textbooks, right? Measure a range, project that range 50% higher, 50% lower. Same thing here, big wicks on each side. That's not what we want to see. So I point all of this out. And if you don't want to trade the gap close, that's okay. There's no reason that you have to. But if I can save you from trying to go long just because we had a big long green candle at the open at the 8:30, then that's a good thing, right? If I can stop you from losing money because you think these big candles are pointing the way the market's going to go, not realizing that we're very likely going to gap close. So here's an example of these gap closes on the intraday. So I did mention they can happen anywhere. We had one of those candles come in at 10 o'clock, like an economic event at 10. Later in the day, we got news somewhere between 12 and 12:30, and that created another one. Now we closed that one really fast. We ran right back up and got it closed. But then at 3 o'clock, we got another one, which dropped us down to close the first one. And then we ran back up and closed the last one. What a day, right? So these can happen anywhere. So if we get this sort of move this morning, at the very least, if you're going to want to trade this thinking that's a bullish move, then let it hit that 50% mark, which we hit when this candle was made. Price came down and hit that mid. If it's going to be bullish, it'll turn around on that mid. It'll come back up and it'll break that high, and then you're good to go. Right? Same thing if it's negative, then you would want to measure the candle to the negative range, hit the mid. Same thing, right? Notice, by the way, price did respond to that midpoint. And if we measure this whole thing and project it to the downside, it looks like it didn't quite hit that 50% mark, but I bet it was close. So you can measure those candles and plot them out, lay them out, right? So we have this opportunity this morning. Don't know for sure that we're going to get this liquidity gap play. At the very least, we are expecting a large candle, and you'll want to use that candle for your analysis. We did make it down to the 10-week. We overshot that 57.50 level that I talked about yesterday. And we got really close to the 57.32 cog line that I had mentioned yesterday. We also got to the week's expected move, and now we're coming back inside that range. These are the ADR levels for the day, the average daily range. We're closer to the upper one than we are the lower one, which implies we would go on up there and hit it. If we didn't have an economic event at 8:30, that would be my base case argument, is we'll just run up there and hit it. But now the clock is ticking. We have to run up there and hit it before 8:30, or econ's going to take over, and then who knows, right? Pivot points, measured moves, structured levels, none of that matters when we get data, and then all that flow comes in. So if we don't hit it before 8:30, then that's off the table. Not saying we can't hit it afterwards. Just don't count on it to be hit just because we were close enough to it. Here, the day's floor pivot, obviously opening lower than yesterday's floor pivot. The channel is completely outside of the range from yesterday. Price hasn't hit it yet, but it's working in that direction. And again, if it wasn't for data, I would say that's a pretty safe bet that we're going to run up and hit that floor pivot. But it needs to do it before 8:30. Otherwise, all bets are off. With that in mind, it's an MDP right now. It's a missed daily pivot, and it's a very wide channel. Wide channels imply that if we break out, the breakout won't stick. Now, think about what it would take to break out of yesterday's range. We would have to run all the way back up to 58.44 and then break out of that and get through the weekly pivot. Is it possible? Oh yeah, price can do whatever the heck it wants. We can absolutely do that. Is it likely? That's the question. And unless the jobs numbers that we get this morning really fires this market up, I don't see what else would galvanize us into such a move with all of this election uncertainty weighing on the market. Plus FOMC next week, which really, got to say, the FOMC is not even the issue, right? It's more the election than anything else. And the Mag 7 with the earnings still. So we could run up there and break out. But this big wide channel implies that even if we did run all the way up there and break out, that we would fail to keep that breakout and we would come back in the range again. Same thing for a test of the low today. If we do break below our own low, this wide channel implies that the breakout doesn't stick and we come back in again. These channels don't make price do anything. So even if we do get that breakout, don't let this influence you to think that, oh, well, the breakout isn't going to stick because 6 said the channel's wide. It's not supposed to. It's supposed to come back in if we break down, but trade price, right? If it continues to run to the downside, then don't argue with it. So I did mention those orange lines yesterday as the 50-period daily moving average and how we could potentially bounce off of those and get a dead cat bounce, maybe back up into 5,800 or into the green and blue lines, the 20 and the 10. And I mentioned we were getting a 10-20 cross on the daily. So now we've got this really big bar from yesterday, which we're going to lay out levels for here in a minute. But that big bar is now boss. Everything that we do is going to be focused on that bar from Halloween. We'll break it down. It's high, it's low, it's midpoint, and everything that we do is going to have to focus on, we got to get out of that range, and it's a really big range. That volume that we talked about yesterday at last week's low looks really tiny in comparison to what we got now. We do have this structure back here from the first week of October. And we've got that 57.32 cog line that kind of lines it all up. We need to hold above that 57.32 or we're going to put 5,700 into play. And if that breaks, well, 55.50 looks pretty good. I know that sounds like an exaggerated number, but that's the same number I've been giving for a while, and the answer doesn't change at this point. So I mentioned they were hedging. We can see the market maker move. I believe that they are hedging because of the job numbers. If I'm wrong, it's because of the other numbers. You're going to want to watch the market maker move to see if after the 8:30 job numbers, it starts to go down. If it doesn't start to go down and it holds steady or maybe even gets larger, then that means they're hedging for the ISM manufacturing at 10 o'clock. All right. If you don't have this label or you don't have Thinkorswim, then go to the options tab on whatever broker you do have and check in the options for the front expiration to be higher than the next expiration out. So just kind of scoot these together so we can see the date next to it. We can see this is a 0-day and a 3-day right there on top. And the 0-day has a higher number than the next day out. This is what the market maker move is recognizing, and it's why we have it right now. Market maker move right there. So you'll be able to see it even if you don't have that label or that indicator, right? Now it's not going to immediately disappear after 8:30. We're going to want to see that number go down. It is a time-based number, right? It's going to expire today either way because the stuff that it's looking at won't exist after today. So even on its own, we should see it diminish because of time. But through the morning, if it isn't the 8:30 event that's going to do it, and instead it's the 10 a.m. event, it will continue to grow because they'll put money in it. There'll be more hedging, or it'll hold steady. And holding steady is not what it's supposed to do, right? It's supposed to gradually decline and go to zero. So after 8:30, say by 9:30, if it still hasn't decreased, you'll know it's for the 10 a.m. one. And that's going to give you a heads up that the 10 a.m. is more of a threat than the 8:30 one. As far as I'm concerned, 8:30 today is the big event, not 10 a.m. I'm wrong if that thing doesn't go away and it's still there at 10 at the same size or bigger. 10-day, 30-minute volume profile. We did get that nice breakdown. At some point, the point of control is going to come down to us. It's going to take a while. It's not moving anytime soon. It has all of these days that it has to take out. And we would need to stay in this new zone and build this volume up. So that's a tall ask on each side. On the other hand, if we get near that point of control, we're likely to go back to it. To do that, we'd have to get back through 5811 cog line, basically through this structure down here, or this structure here. Once we get back up in this zone, then we can get stuck in that zone again. But that's a long ways off. So we're going to add another VPOC to today, although we're literally hitting this spot while I'm streaming. But we're going to put it on there anyways, in case we can't jump above it. So technically, it's no longer VPOC because we just hit it. Some analysts will say, well, we didn't close on the other side of it, so I'm going to keep it. I would say I need to adjust it by a tick, maybe 2 ticks. So it didn't look like we were in the center there. It's close enough either way. All right, there's the mid. So we hit it. We didn't close on the other side of it. There's no wrong answer here. If you think closing on the other side is what counts, then the VPOC is still active. If you think just touching the thing means it's no longer active, well, then there you go. The textbooks are going to tell you, put that line there. Whether or not it's been hit is irrelevant. Put it on there. So it's up to you. You won't miss anything, right? If you don't have it on there, but it can provide insight if you do leave it on there. Without all the fancy talk and bias and everything else that goes with it, a simple fact is that's where the greatest amount of trading took place yesterday. There's no argument to that statement, right? I'm not giving you any bias, not encouraging you to believe it's resistive or supportive. It's just a fact. That's where the greatest amount of trading took place yesterday. Now, we can believe that if we go back to that place on the intraday, there will be some trader's remorse, and that some people who got in there yesterday at that spot are going to reconsider their trade today if we're back at that spot, right? So certainly a level of interest. All right, I mentioned we hit the edge of the week's range. Now we're supposed to close inside this range 70% of the time, because this is a 1 standard deviation range. That's the way it works. 68 point blah, 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 right? Whatever. Just round it up and say 70. But this is the S&P, and it has a more robust, more accurate expected move than anything else that exists. It's been favored for years, right? When everything else only had monthlies, it had weeklies. When everything else had weeklies, it had 3 a week. And then it went to 1 every day. So then you had 5 days a week. There's more background data and depth and options flow in the S&P than any other product. So because of that flow, because of the amount of trading that happens in it, it is the most accurate expected move product that you could ever find. And that's why it has such a high threshold. So at the bare minimum, we would expect it to close inside this range 7 out of 10 weeks. So you can just count back 10 weeks and ask how many times on Friday did we close outside of this box? If it's less than 7, you got issues. There are times where it'll happen once in a while. Once in a while is no big deal, right? That's going to happen. But what you don't want is repeated failure week after week after week, because that starts to signal that there's something wrong. So 1, 2, 3, 4, 5, 6 in a row, where, by the way, out of all of those, we only had 2 that just barely interacted with their week's edge, because we're getting a lot of really tight constricting price action. Then we had a week where we broke out, closed outside, back-to-back weeks, right? One of those looks like a holiday week. I don't like to count holiday weeks, but we kind of got to on this one, since we're counting to see if there was failure or not, and there absolutely was failure. So that's 2 weeks back-to-back. Otherwise, that's it. And we've got our numbers. 2 out of 10, that's 80%. So we are doing what we should be doing. If we weren't, then that number would be much lower. We'd have closed outside the box 4 or 5 times in that count. The likelihood that we close inside the range today is pretty high, all things considered, but we still need the jobs data. We still need the 10 o'clock data, and that can break us back outside of this box. We're 1% below the 10-day moving average. That's not quite the sweet spot, but it looks like we got into that sweet spot yesterday, and now we're already on the way back out. That's a good thing. Just remember, we can be on our way back out, and then we can go right back down again. Nothing says that it's got to be a nice, smooth curve every time. It can fail on us. But it's looking good so far. We dropped below that 1.5%, and now we're working our way back towards the 10-day. If this is just a nice pullback in the market, then we'll work our way back up. We'll break out and continue to go to the upside. But I'm going to point out some issues with that in a minute when we evaluate that big candle from yesterday. Looking at the 10-week, we're basically there, right? We know we went through it yesterday. We came back up. We're crossing through it. We're on it. Now we can go under it and then get back above it again. But at this point, now that we're here, it's like a gravity. We're going to expect to chop around and hold this level and build up structure and then leave the range. Which way we leave the range is going to really dictate how much that 10 is going to influence us. So there's the 10. That's like a zone that we're in around it. And now we're leaving that zone, which is going to make that supportive. If we come down and we break that and it does not end up being supportive and we get underneath it, then it's been validated, checked, tested, and it failed. And the breakdown can get us down into that 5550, 5500 that I'd been talking about. All right, 5788. That's really close to 5792, but we'll just use the 88. There's your halfback that we have to get through. Now, here's the issue with what's going on in price. We set that high and we set a low here. That's a higher low. But then we set a lower high and now we've got a lower low. This is just a high, not a lower high. So if we want to maybe just knock that off. One lower high, one lower low. For a full set, you need two lower highs and two lower lows. So, back here, you had your high, a higher low, lower high, lower low, lower high. We broke that, and oh boy, down it went, right? Because the next one would have been a lower low. Well, they just made that lower low and ran it. We're in the same boat again. We also need to worry about this structure back here. So we got a precarious situation in the market, and the S&P is famous for breaking things, breaking patterns that we thought were good, and then it turns out that it wasn't. So that's the issue. There is technical analysis that says that has to hold or else. But when it comes to the or else, S&P has proven time again that it can break patterns. It can be a perfect head and shoulders and break it. It can be, a perfect wedge and fail it. So, don't get hung up on it as much as if it is something else. But speaking of something else, that is a rising wedge. And on that rising wedge, we had this kind of blow off top, which is not unusual. And now we're breaking down out of it. We would measure this range back here and plot that to the downside because that's what you do in analysis, right? You measure the widest part of the range and you project it from the breakout point down. And you can give it 50% and then 100%. You don't have to just mark out the whole 100%. But 50%, that gets us down into that 5,500 range that I've been talking about. And now you know why I've been talking about it, because it fits the measured move for this wedge. We're on our way, right? If that 5732 or, even if we give it an overshoot and say 5,700, if that fails, then 55 or 5550 is on the table. All right, so with the econ on deck, looking at what is up or what is down is going to be a little misleading. But Bitcoin is down 5%. It's still up more than 4 3/4 over the last 5 days, but it is down some. VIX is down 4%, but it's still up 12 on the week. And negative Mag 7 names are down, which is confusing, but it just means the Mag 7 names are up because there is an FNG U and an FNG D. U is up, D is down, FNG is fangs. So it's looking at Mag 7 up volume, or the other one's looking at Mag 7 down volume. The up volume is up. We've also got XXX semiconductors up. Another ETF on the Mag 7 up. Semiconductors, energy, gold miners. China is lagging a bit. My benchmark on what is up or down stops at 0.5%, right? So I would only be looking at names that are up at least 0.5%. I use that number because of how early we do the morning briefing. If you're doing this on your own later, say closer to 9 o'clock, you want to use a bigger number than 0.5%. Use 1% or even 1.5%. And then look at the groups that are up to have an idea of something worth trading today based on, the sector or the industry that it belongs in. For our purposes, we're more focused on the breadth of what is up. So take a look at the S&P 100. We have 21% of the S&P 100 up more than 0.5%. That's a good ratio, good number. It's not wildly bullish, but it's good. And it's very likely a little bit of a mean reversion snapback. But either way, we'll take it. From a breadth perspective, 21%, that's not too bad. Closer to 9 o'clock or maybe 9:30, if we think it's going to be one of those ripper days to the upside, you're going to want to see something better than 21%, but also use something better than my 0.5% ratio or benchmark. Names that are down at least 0.5% in the S&P, we got 2. All right, so 2% of the S&P is down 0.5%. That's a very bullish ratio if we compared those two numbers. For the NASDAQ 100, 6 names are down at least 0.5%. And 22 names are up at least 0.5%. Again, that's really bullish. If we just compare those two numbers from what's down versus what's up. 22%, if we just look at that number alone, yeah, it's a good bullish number, but it's not wild bullish. And it's really heavy in semiconductors. That's not necessarily a bad thing. We need those if we're going to have one of those big ripper days. But it does also mean that it wouldn't take much to shut that rally down if, say, NVIDIA had some bad news. It's going to shut all these other guys down. Nat gas doesn't matter. Solar down, and building materials or materials. And that one's trying to work itself back. but it's just an algo print. So at this point, we don't give that a lot of weight. Flip everything around to what's up this morning. Notice how the distinction here, we got just this little bit of red and then all this green. And how many of these sectors and groups are up more than 0.5%? Because we've got oil and gas, bonds, emerging markets, which is basically China, pot stocks, China again, retail, gold miners, semiconductors, pot stocks again, crude. That's a lot of groups, a rising tide lifting all boats. So it's a really good start, but we got to get through this economic data this morning. We want to keep our eye on the hedging activity this morning. Keep an eye on that market maker move and see if that number continues to increase after 8:30, which will be a warning that tells us they're really focused on 10 a.m. Just like yesterday, I give a little over and under, only this one isn't going to make sense without the data print, right? So normally we would say, if we break this low, just like I said yesterday, you break this 57.32 cog line, and we're looking at 57.11, 5,700. You get below 5,700 and things are going to get nasty fast. But we've got jobs data, so we could get this really big bar that spikes us down and puts us underneath this. If that's how we get down there, don't try to short it from there, right? We went through this at the start today. Expect a liquidity gap, and maybe we don't close the gap. Maybe the big bar takes us down there and then we continue to fall. I don't think we will, but it's a liquidity gap play until proven otherwise. So if that's how we get below there this morning, don't expect this to just crash and burn. But if we get non-farm payrolls and everything's just and price does its little jitter and we got a big wide wicky candle, and then we get into the open and we grind our way down here and we break down below this put wall and we break down below our own Globex low, then yeah, now it's game on. 57.11 is next, and then 5,700, 56.92, 56.50, right on down the line, right? Otherwise, the opposite is true. We've got that half back marked. Just take last week's range, cut it in half. Take yesterday's range, cut it in half. So there's your half back. It lines up with the 111 from the weekly. From a different, we'll just get rid of that one. Let's just knock that off for now. 57.88 for the upside run. That's yesterday's midpoint. It's pretty close to 57.92, right? So if we can get above this ADR half, then we can get to 57.92, which is the zero gamma. Imagine that, zero gamma right on the cog line. And then 5,800, which is the ADR full. So really nice setup today. We just got to get through the data. 8:30, 10 o'clock. That's it. The afternoon is free. So, as long as things look good, an afternoon 0 day is on the table. Watch the clock. Be careful. Be safe. I'll see y'all tomorrow.